I'm hearing some crazy news that Vanguard, the second largest asset manager in the world, may be looking to bend the knee and start allowing clients to buy crypto ETFs, Bitcoin ETFs. I want to talk about that. Where is this coming from? How important is this? Because it is massive. If this actually does happen, it's massive in terms of the amount of clients that they have, the amount of money that they have. It also signifies a change, a massive change, a change of the guard at Vanguard. And we'll be going through this. We also have some news from Tom Lee on the AI trade, maybe tech bubble that we're seeing right now. We also have some good news that came in this morning, some economic news. It's causing Bitcoin to go up a little bit. Last time I checked, too, the traditional markets were up a good amount. So we'll be going through that. If you don't mind, though, hit subscribe so you can see future videos just like this one. Also, if you want to trade crypto, I think now is a great time to get your account set up because we are right ahead of the most bullish time of the 4-year cycle, the fourth quarter of the post-halving year, which that starts in less than a week. So if you want to get your account set up on BYDFi, you can start trading. You can get up to $13,000. This goes for another 12 days. So the more you trade, the more you get. And then you can also be entered to win an iPhone 17, even if you just deposited $5,000 on the platform and just let it sit there and then take it out. You might win a new iPhone. So check that out underneath the video. They also allow you to trade Coin M, which means you can trade crypto with crypto. For example, you can trade Bitcoin with Bitcoin as collateral, and you can get rewarded in more Bitcoin. I think now's a great time to trade. You can see we're actually we were around 108,600, which means we did set a higher low since just a couple weeks ago, actually 3.5 weeks ago, when we were at 107,000. September's usually a pretty bad month for Bitcoin, but we're still green considering we started the month around 107,000. Still green slightly. Today is a good day though. Bitcoin's moving up slightly. You can see from the bottom, 109,600. Might not seem like a good day because we're down 1.25%, but we're starting to move off the bottom, and we have traditional markets moving up as well. Nasdaq's up 0.46%. S&P 500's up 0.64%. On this news, PCE came in at expectations, 0.3% month over month. So year over year, we're at 2.7%. Core came in at 0.2%. So year over year, core is 2.9%. So overall, pretty good news. I mean, PCE is the Fed's preferred inflation gauge. Yesterday, we got a revision up in the GDP, up to 3.8. So it shows that the market the economy is actually doing really well. A lot of that is based on like AI spend, and Tom Lee will actually talk about that in a moment. But a lot of the big companies doing well, maybe not a lot of the smaller companies. They're interest rate sensitive, or a lot of people that are looking for jobs, they're having a tougher time. But if inflation can stay down and GDP is high, that could be the Goldilocks scenario, the best scenario where the economy does really well. We don't have rampant inflation. The Fed still can lower rates, although they might not lower rates quite as aggressively if the economy is doing so well. But still, this is a pretty good scenario I think we're in right now, especially considering where we were just a few years ago. Now, this is the big news of the day. $9 trillion Vanguard is exploring offering Bitcoin and crypto ETF access to its U.S. brokerage clients. Now, where is this coming from? We hear from Bitcoin Magazine. I'd say they're a pretty trustworthy source on Twitter, but this is coming from Eleanor Terrett, who works at Crypto America, former Fox Business. She's basically a reporter. She said, Vanguard eyes crypto ETF access for brokerage clients. The world's second largest asset manager, Vanguard, is preparing to allow access to crypto ETFs on its brokerage platform, according to a source familiar with the matter. And then Eric Balkunis, who works for Bloomberg, he's like the senior ETF analyst at Bloomberg, says Vanguard is looking to end the Bitcoin ETF ban, aka bend the knee. The dynamics have been changing. Nice scoop by Eleanor. We heard chatter of this too. Smart of them. Bitcoin and ETH ETFs are hugely popular, and Salim, the CEO, was one of the IBIT's midwives, so he knows. Now, I don't really remember what he's talking about with their CEO being one of the midwives of IBIT, But he wrote an article saying Vanguard's anti-Bitcoin stance and talked about why this could be overturned by the new CEO. And he also reminds us that, hey, even though Bitcoin's had a bad week, still up like 350%, which actually it's up more than that from the bottom, right? We're at 16,500 or so. Vanguard has 50 million investors. Obviously, many are not Bitcoin type, but that's massive. They are the biggest the biggest fund company in the US by 2 times over. Yeah, so they have the largest ETF in the world in terms of AUM with VOO. I actually hold VOO. And now they're changing, right? They may be acquiring or allowing people to buy Bitcoin. Now, in the past, they've explained that they don't want to offer this because they don't like non-productive assets, kind of like Warren Buffett, right? They don't allow like gold ETFs. They're not going to allow Bitcoin, is what they've said. However, Tim Buckley, who had run the company for 33 years, retired. Sorry, he worked at the company for 33 years, 6 years as CEO. He retired the month after the Bitcoin ETFs come out. He was given a lot of flack. A lot of people hated on Vanguard, and there's a trending hashtag like what was it? Fire Vanguard or something like that, or Down with Vanguard on Twitter or X when this was happening. And within a month, he retires, right? Passing the reins down to someone else. I thought at the time, and I made a video of it, I think that was partly due to the Bitcoin blowback. Right? I could be wrong, but out of nowhere, it's weird with such a long career that he just decides to retire right after all that heat from the Bitcoin ETFs. Keep in mind, IBIT, BlackRock's ETF, already gets higher fees each year than Vanguard's most successful ETF in terms of assets under management. They make more from IBIT, BlackRock does, than VOO makes Vanguard. So I'm thinking they probably want access to that. There are clients that have left. I'm guessing it's not that significant, but it's probably notable. I've talked to a handful of people myself that left Vanguard because they weren't offering the IBIT ETF or FBTC. They have $7.2 trillion in AUM as well, and usually those numbers are old with us hitting new all-time highs on the S&P 500. I'm guessing it's closer to $8, $9, $10 trillion in AUM. I don't think they're going to bring in, $100 billion the first couple days, but I wouldn't be surprised if they rolled it out, allowed people to buy it, and then some people took advantage of it. And then that would be another tailwind, right? It also signifies pretty much everyone has to allow the ETFs to be bought, the Bitcoin ETFs. So I think that will be really important if that does happen. Of course, we don't know for sure that it's going to happen at this point. $12.5 trillion BlackRock files for a Bitcoin premium income ETF. Okay, so it sounds maybe similar to like MSTY or something, but maybe selling options on the underlying Bitcoin ETFs or on IBIT or something like that. I'm not exactly sure what this will look like yet. Maybe there'll be more information. I mean, they filed for it, so I could dig through some documents, I'm sure. But it'd be interesting if they offer different covered call ETFs or wheel strategy ETFs, whatever they do, and there were like different levels of it. So maybe you're taking advantage of more of the appreciation and you get less premium with one ETF. Then like maybe there's a medium where maybe you get, 10% dividend a year, and then you still get a good amount of upside because they are quite volatile. And then like there's one that pays a higher dividend, maybe, 20% or something like that. And you get some upside potential, but less. It would be interesting. I mean, MSTY, I think, has underperformed largely. That's the covered call ETF that sells covered calls or synthetic options on MSTR. But that does pay a really high dividend as well, like over 100%. So I think they could do something with, with the Bitcoin ETFs that doesn't pay quite that much, but allows people to have more upside. I'd be interested in seeing that. And seeing how that performs over time. Now, the ETFs haven't been a big tailwind recently. If you look over the last week or two, this is the Bitcoin ETFs. It's been kind of back and forth, green days and red days. Yesterday, we saw $250 million worth fall out of the ETFs. And actually, for the Ethereum ETF, we saw almost the exact same thing. Crypto liquidations have been high as well, so be careful out there. Right? I'm not using extremely high leverage. I think that's a bit risky now with so much being liquidated from the market. I am using low leverage, and I actually just opened a new position yesterday. I talked about it in my Telegram, which is completely free. You can check that out underneath the video. Keep in mind, too, we have $21 billion in Bitcoin and Ethereum options expiring today. So expect some volatility, right? Don't be surprised if we go down to new lows or something like that. Whales like to manipulate and freak out the market, showing us a higher bounce here than we saw 3.5 weeks ago. I would not be surprised if there are whales out there that want us to start to bounce so that people go long, and then they flush us down to new lows, like slightly below what we saw back in early September. But also, I'm not changing anything. I'm not scared of that if that's what happens. I'm totally fine with that because I'm not using very aggressive leverage. So I do have leverage positions, but if we move down to where I might get liquidated, I'll add more margin or open a new position. So I'm not worried. And I think this is completely normal. Like I said, September is usually a red month. We're still green right now. So I would not be surprised if the whales try to manipulate us down, but I am very bullish for the end of the year and, the next year in general. If we look, altcoins are still down, right? Ethereum under 4,000. It looks like it's trying to consolidate right now. Like I said yesterday, we've seen a lot of price action right in this region, all the way back to January of 2022, right? Like 3,800. Here we saw 4,100, then 3,900, then 4,000, and then we got rejected right here at like 3,900 back in July, and then we broke out finally. So again, I would not be surprised to see us jump off this line here fairly soon if we continue moving up. Otherwise, again, we might see the whales try to flush us down to like 3,700 or so, freak out the market, and then maybe it returns up. Of course, approach at your own risk. Let's look at what Tom Lee just said about the market. And he talks a little bit more about the stock market, but we'll play it all so you can see everything here.
We're in a period where there is a super cycle and exponential growth opportunities within AI. But it doesn't mean every company that has elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is NVIDIA trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210 times forward earnings. So NVIDIA to me is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of an NVIDIA, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, as much as he looks at other names which have gone, parabolic, and they're related to AI, and that's where he says, whoa, we're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to NVIDIA and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today. from his report, and he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, NVIDIA is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies...
That's something interesting that I think you pointed out there. Sure, NVIDIA is a large part of the overall market, or a large part of the indices, but it's also very profitable and it's growing very quickly. That's something that I think a lot of people aren't looking at right now. Like if you ever have looked at PEG ratios, right? PE divided by growth. How quickly are the largest companies in the world growing right now compared to history, where, you know, maybe we are at a high price to earnings ratio for the S&P 500, but also the biggest companies in the world are growing very quickly right now. You look at Google, Amazon, Facebook, Meta, NVIDIA, they're growing earnings by 10 to 50% a year, depending on the company. So yeah, they might be valued a little bit heavier than companies of the past, but they're also growing their high margin businesses, growing very quickly. Sure, they're reinvesting in AI a lot and CapEx, and there's some future growth priced in. But also, if they weren't investing in these areas, they would have so much capital to return to shareholders, whether it's through buybacks or through dividends. Like, they're just deciding where to put this money, and they think they'll get a better return in AI. Let's say it blows up. Okay, yeah, the market's going to freak out for a while, and then all these companies will be able to put money back into their own businesses in other places. NVIDIA obviously would do pretty poorly in that scenario, but you start thinking about the other big tech companies, like, they're highly profitable. So, I think people are maybe overly worried right now. Let's keep going though.
Are excited about, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
I mean, I look at a stock like Oracle, for example, only to pick it out because it's up more than 30% this month. Now, it obviously had the moment around earnings where it added such a tremendous amount of market cap after that event. I bring it up if only because it was initiated sell today at one firm on Wall Street, in part because they suggest that you've got some really aggressive assumptions that are coming with this stock. Now, it's down 5% today because a lot of these names in what you would consider the momentum basket have rolled over a little bit. But the notion that the assumptions are so big that there's inherent risk in and of itself within that.
Scott, I think that there is going to be moments where it feels like we're possibly topping, and today is coming at a time when we have this Oracle report and stocks are generally soft. But number one, I think it's always really healthy to see corrections in a super cycle. But I do think it's really difficult for someone to actually ring the bell at the top. And in fact, like if we look at Palantir or Tesla or NVIDIA, I think that there have been, 25 bell ringings at the top at every waypoint along the way. to me, I think the real test is going to be that we see a day where investors are convinced there's absolutely nothing that is wrong with the thesis and it's bulletproof, and yet stocks make announcements and they go down, and companies actually have negative returns. I have not seen that yet. In fact, to me, it's reflexive to see that every time markets flatten out after posting gains, we have a lot of people declaring the top. To me, that's a really healthy sign that there is very little conviction about this bull market, and I do think it's healthy to actually see skepticism. So I'm not opposed to seeing like these reports, but it's healthy.
Do you think that equities are especially vulnerable here, as we wrote in our intro today, as BTIG suggests they are? The most since the April low. Do you feel the same? I should also mention it comes within the same context of commentary recently from the Fed chair, who didn't go out of his way when he answered the question about the equity markets to suggest it's wildly overvalued. But nonetheless, he did say that stocks are fairly highly valued. He could have said, I think they're fairly valued. He didn't. He said they're fairly highly valued when he answered that question. You put that into the mix too when you consider your answer.
Yes. Well, I have a lot of respect for Fed Chair Powell, but I don't remember the last time any FOMC member actually said stocks are attractively valued, because I don't think it's their job to comment on equity valuations that way. And if we think about where, again, market valuations are, I'd be very concerned if the most important stock, like NVIDIA, was trading at a multiple that couldn't deliver returns. But it's the most important company in the world, 40% plus revenue growth. It's trading at 26 times forward earnings.
That's crazy. So the reason that's not trading at a higher premium is just that people don't know if it will continue, not just continue to grow, but they don't know if it will actually see like shrinking revenue if these big companies aren't seeing a huge benefit to their underlying business. So people aren't pricing this the way that they should, especially considering the growth, because they're worried that not only will it maybe not grow as much, but it would actually see negative growth. And it's interesting that Jerome Powell is even speaking about stock valuations. That's not part of their dual mandate at all. And there's so many things that he just won't talk about. He says no comment. So it's interesting that he's talking about stock valuations, but I really think it comes back to him trying to cool down the market, not trying to let inflation run away. So he really is trying to talk down the market, like, hey, yeah, things are a little bit expensive. Don't feel too rich. Don't spend too much money because we could see a crash. So, I think that is his main reason for even talk about it in the first place when it's not his job.
Is hardly demanding for a company that makes a product that every single company in the world that is involved with AI actually needs. They can't replace it with anything else. So I don't think it's expensive. When you ask about April lows and valuation vulnerability, I think there's really two big differences. One is monetary policy was actually quite tight in April, and the risk was actually the Fed wouldn't even consider intervening, and yet markets managed to stage a 30% rally. Today we have a Fed that's not necessarily pounding the table that it's in a dovish cycle, but they've understood that they need to now use their hand to support employment. That's a sea change, actually, and as we know, ISM's been below 50 for 31 months. It's the longest stretch in the history of the ISM index. I think if the ISM breaks above 50, that's a recovery in confidence in capital spending. That would support a broadening of the economy, and I think that would be good for equities.
Well, speaking of Fed policy, and you stay with me, Tom, for a moment, Ken Griffin also gave his outlook today for what he thinks the Fed will do after cutting rates last week. The billionaire investor said he sees only one cut over the remainder of this year, outside chance of two, as inflation remains higher than the Fed's target of 2% and may still get worse.
The belief is that the inflationary impulse from tariffs has only passed about 50% through to the economy at this point in time.
So you see it coming?
It's still coming. It's still coming.
It's still coming, he said. He also weighed in on the issue of Fed independence. Listen.
If I were the president, I would let the Fed do their job, and I would let the Fed have as much perceived and real independence as possible, because the Fed often has to make choices that are pretty painful to make. And if the president's perceived as being in control of the Fed, then what happens when those painful choices have to be made?
Joining me now is the Wall Street Journal's chief economics correspondent, Nick Timmerman.
Okay, so let's just scour to see if Tom speaks anymore. Yeah, let's play this end part here.
Missed something there.
Well, you know, it's the Fed chair. When he talks about the equity market, we glom onto it. Nick, I'll see you soon. Thank you. Nick Timmerman with the Wall Street Journal. Of course, Tom Lee is still with us. Let's wrap this, Tom, with your reaction to a little bit of what Ken Griffin said. If he's right, and we have one cut for the remainder of the year, and that in his words, it's coming, about inflation from tariffs, would your forecast for this market be wrong?
Scott, if the Fed does one cut, I think that markets would interpret that in a good way, in the sense that they'd rather see the Fed cutting into a strong economy rather than weak. So I don't think that that's necessarily a negative. But I think one thing that needs to be clarified, because I'm listening both carefully to what Nick said and what Ken said about inflation coming, there is this idea, and Fed Chair Powell talked about it, which is that there's the imputed effect of tariffs coming because these tariff costs have been absorbed and now they're working their way to the consumer. That's what the Fed would call an imputed inflation rate. You know, the effect was already felt, the charges are in place, but it takes a while for it to show up in a statistical way. That was exactly what happened with the housing prices, that housing prices surged in 2021 and 2022, but it became imputed inflation in 2023. We know that the Fed was lagging in its easing because of that imputed shelter inflation, but the reality is they should have been easing sooner, maybe not 50 initially. And so I think that we have to be careful. When the Fed's talking about that imputed effect, it doesn't mean we have to start a new hiking cycle just because it takes a while to show up. And I think that's why markets are going to see through that.
Tom, we'll see you soon.
Okay, so it may seem like I'm always bullish. I've been thinking about this. You know, I am a bit of a permabull, but I also always have some cash on the sidelines in case we see a dip that is juicy, and that kind of helps psychologically, right? Probably even more than just like numbers wise. It would be better if I just put all my money into the market whenever I had it. But I always keep some cash because psychologically that helps. Now, the reason that I'm more of a perma-bull is because it pays off to be a perma-bull, right? Like Tom Lee, very bullish most of the time, right? He might exercise some caution, but he largely is bullish. And it makes sense to be bullish because at the end of the day, bears sound smart, bulls get rich, right? Like the markets go up over time because of debasement of currency and because companies can continue to get more efficient. So the stock market will continue to go up. Sure, there might be momentary dips, but largely it will go up. Same thing with Bitcoin, right? It will go up and up and up and up, and then take a dip and then go up and up and up, and then take a dip and then go sideways for a while and then go up again. I think it makes sense to be bullish even on these assets now. I've actually been deploying a lot of capital. I've said this before, but I had a property that I was going to buy that was a very expensive property, but it kind of fell through. So I had a lot of money sitting on the sidelines all of a sudden, and I almost felt like, you know, I have too much capital here. Like I need to deploy into the markets because yes, I can sit on, you know, 20% cash or more, but I need to deploy it, right? I'm not gonna need this cash in the next year or two. So even if we see a big dip, right, I'd rather deploy it. So I'm deploying it with automatic buys. I'm automatic buying every single day, and I should run through it in a few months, maybe 3 months. But then I'm making more money on top of it, which I'm deploying into the market. So I will always keep some cash, but I'd caution about keeping too much. Because right now, the Fed is lowering rates. The economy looks pretty good. We have companies still growing very aggressively. The AI trade, I still think, is relatively young because while some people say that we're deep into it and that there's so much riding on this, and if it doesn't pay off, it could be devastating to markets. The other side is we have the best companies in the world, all of them deploying billions and tens of billions and hundreds of billions of dollars into AI. Don't you think that they have a better idea of what makes sense, like what will pay off than we do? It's not like the metaverse where just like one company, Meta, Facebook, went heavy into it. This is every single big tech company is going heavy into AI. So all of them would have to be wrong. I feel like that's very unlikely. And we haven't even seen the profitability really come from this yet. Sure, we've seen it with like some hardware providers and cloud companies, but that's it at this point. Like we haven't seen the end product that makes all these companies highly efficient, very high margin. And when that starts to hit, I mean, imagine if all of a sudden Amazon's margins on their retail business quadruple. Right? It's possible, right? If they automate a lot of it. Let's say all of a sudden they go from, I don't even know what their retail business is, 3% margins to 12%. And they're doing hundreds of billions of dollars a year in revenue. Like that could be massive. This could be huge profitability for them down the line. And this is coming, right? This is coming, I think, in the next 5 or 10 years, a lot of this profitability from AI. So do you want to get out right ahead of that because you're looking for a 10% dip, or would you rather just ride the wave, right? Let me know your thoughts on this underneath the video. I think now's a great setup. I don't think, I don't think everything's necessarily super cheap, but it was in April. I don't think it's extremely overvalued either right now, assuming you're dollar cost averaging and you're not just trying to like nail the top. I still do practice taking some profits on trades in crypto with leverage, but I'm largely just buying in the stock market. I'm buying assets that I want to hold on to, even if we go into a bear market, because they're very strong companies that will continue to get bigger, whether we're in a bear market or a bull market or a bad economy or a good economy. They'll continue to gain market dominance. And yeah, I am trading a bit. If you want to trade over on BYDeFi, there's a link to that underneath the video. You can see the market dipping slightly, like Ethereum's fallen down a little bit. Bitcoin fell down under 109,000. The traditional market also fell down a little bit since we started this video. Of course, this is a long video by now, but that's because of some more economic data that came out. So the PCE came in pretty good, but then we did get personal income coming in higher than expected, 0.4% versus the expectation of 0.3, personal spending at 0.6 versus 0.5. Yeah, so if we get a dip, I think it's a decent buying opportunity. Of course, I'm not putting in all my money, right? You have to have a long-term vision and be able to absorb some of these dips. Of course, like I said, there's going to be manipulation, so be ready for what's going to happen this weekend. Lower liquidity, be ready for some volatility. I do have cash ready to deploy into the markets, and I do like leverage trading. I think now is a good time to do it if you want to do it. Of course, make sure you understand the risks. There's a link to BYDeFi underneath the video. Now, let me know what you're doing this weekend down below in the comments. We're actually going to a German beer festival for Oktoberfest. So let me know if you're doing anything fun down below. I'll know if you made it this far in the video. Of course, you can check out BYDeFi as well. I really appreciate it. I'll see y'all soon. Bye.